and welcome to June's episode of the Rubicoin podcast, coming to you live from the top floor of Rubicoin HQ here in Dublin, Ireland. With me this week is Emmet Savage, the CEO of Rubicoin, Rory Meabh, our chief investor, and Maeve Redmond, the head of customer experience design. This month, we're going to talk about Howard Schultz leaving Starbucks, Amazon making its move onto the soccer pitch, and we have some very new and very, very random ideas we want your opinion on at the end of the show. Last week, Howard Schultz announced that he plans to step down from his role as chairman of Starbucks, bringing an end to his 36-year relationship with the company. Emmet, how instrumental has Schultz been in creating the global coffee house that we all know today?
His influence, James, has been significant. I'd call it significant. As Maeve just said, I'd love to buy the guy a coffee.
I don't think he needs it.
No. Huge, absolutely huge. Maeve, what was the story? He bought the Starbucks chain of 6 coffee shops for $4 million, is that right?
I don't know the amount, but that's how the story goes. Yeah, I think he was kind of interested in coffee culture and had an actual genuine interest in coffee as a core product. Mm-hmm. So I think he went and did some research in Italy, and that's why I like the guy. I'm kind of interested in his his kind of beginnings, and his personality. There's a really good episode of How I Built This with Guy Raz that Rory I think put me onto, and I really listened to it, and it's just a really enjoyable era. He's a very likable character for a billionaire and one of the most successful entrepreneurs in the US.
We don't get less likeable because you have billions.
True, but I mean, sometimes you kind of feel like you're forced to like them because of their kudos. Whereas this is a guy that I really wanted to listen to more of. Yeah.
He did bring Starbucks revenue from 57 million in 1991 to 22.5 billion this year.
Not
bad. See, significant. I told you it was significant.
Absolutely.
Yeah, so he's obviously a massive figure. I think he's kind of been out of Starbucks' main game for a while now.
Yeah.
He stepped down before actually and came back in 2008 when he realised the company was going to pot. They were expanded too quickly. The coffee had really died down in quality, and he came back in, closed down a lot of stores, stopped a lot of expansion. I think he closed all the stores down to teach the baristas how to make coffee.
Okay.
And kind of got back to the core focus of the business. So yeah, maybe he'll be back again, but it seems like he's slowly been edging his way out of the business. He took over their premium brand recently and became executive chairman, and he's left Kevin Johnson in charge, who's a veteran of the company who already seems to be doing a good job. He was quite proactive in the most recent scandal, I suppose, where 2 black men were arrested while they were waiting for their friends in Philadelphia.
Yeah.
So I think he's handed over the company to someone with good clout.
Mm-hmm. Yeah. And as well as when he stepped down as CEO last year, I think he took a large role in the philanthropic efforts at Starbucks. This has kind of led a lot of people to speculate maybe that he's eyeing up the White House for his next venture. What do you think the possibility of that is? Or is it just rumour?
Yeah, so he said before he wasn't interested at all. He softened that stance recently when he said, all options were open. He's a staunch Democrat. I suppose, anything's possible these days.
Yeah.
Yeah. We here in Dublin don't really have a good view of who the Democrats are cultivating as a candidate for the next election. But certainly Schultz carries so much brand and clout, along with other personalities such as Dwayne Johnson.
The rivals.
Exactly.
They bring the country together.
Yeah.
The mention of brand when it comes to Schultz, I think, is important. The anecdote about the cheese toasty that Starbucks put on the menu.
Yeah.
Did you say 2008, Rory, was
That's when he came
comeback?
back, yeah.
I think that was the time where he walked into a regional Starbucks and they were frying melted cheese for a sandwich, and the smell of the burnt cheese was basically contaminating the smell of the excellent coffee.
Yeah.
So he just pulled them from the menu that day.
Yeah.
Which, is fairly severe, but it just shows you how much he believes in the core brand and the core product, which I think is always a good sign if someone is that strong about it.
I don't mind the smell of melting cheese, to be honest.
With coffee.
Neither.
That's nice.
As many of our soccer fan listeners might know, Amazon recently bought the rights to a limited amount of English Premier League matches starting from the 2019 to 2020 season. Rory, I know you're a big Manchester United fan yourself. Although Amazon has only bought the rights to about 20 matches per season, how big of an upset do you think this could be for soccer fans this side of the Atlantic?
I wouldn't call it an upset.
Okay.
Just yet. I mean, for years, soccer rights have been dominated by two companies, Sky Sports and BT Sports. And what's happened is, in order to see a limited number of matches every year that your team might be involved in, you've had to pay really outlandish prices because it's all been bundled together with one package. It's a similar story over in the States with ESPN. And I think, times are changing. I have never done this myself, but I've heard it's very easy to illegally stream sporting events
Disclaimer.
Through the internet. So, I mean, if you're an Amazon customer and you haven't got Prime yet, this might just be the little push you need to get into it. They've got 20 games for the season, 10 of which on Boxing Day, which is a huge sporting day. All 20 teams play. People have been cooped up with their families for the last 5 days, are dying to get away from it.
It's the day after Christmas for our American listeners might not know.
Oh yes, sorry.
So it's a big day for English soccer. So it's kind of a disruption. I feel that they got one of the biggest days of soccer exclusively.
Yeah, definitely. And I mean, this is a dip the toe investment for Amazon. I think the value of the deal was something around $90 million, which is absolutely nothing to them. It's expanding their live sports streaming, which includes the US Open and some NFL games in the States. So something that they're definitely looking into. If they see kind of any uptick in Prime membership due to it, I'm sure it's something they'll expand in the coming years.
I guess what we're looking at is another proof point that Amazon is everybody's competitor, or at least can become anyone's competitor. We saw this in action when they acquired Whole Foods, where suddenly the world woke up and realised that Amazon was now in the grocery store business. And I guess now we're looking at Amazon entering the distribution of streaming sports business. And as Rory said, they're just going in light, thin end of the wedge, 20 matches, and in no time at all, they will either dominate or have a significant portion of that market if it's feasible for their business model.
Yeah, it could create kind of a very disjointed customer experience, though. Having now 3 providers of English soccer matches for users to jump between, especially if you're trying to follow your favourite team.
Yeah.
But the Premiership is a competitive bidding process.
Yeah.
So you would not want to be bidding against Amazon if they've decided they're going to do something. So right now Sky have the rights. If Amazon have proven to themselves that this is an asset worth acquiring, they've deep pockets.
Does that mean, though, that customers do actually have to buy into Sky Sports, BT and Amazon to see the full Premier League?
Yeah, if you want every match.
Yeah, I suppose that's the fear, that we're getting away from these big cable bundles. What you're going to end up with is something similar, and just having to have multiple subscriptions if you want to get the entire package. And I think that is a worry for consumers down the line, but at least there's another player involved now, which is evening up the playing field a little bit.
Yeah, a bit of competitiveness might help also.
Yeah.
So, as this is the 5th episode of the Rubicoin podcast to date, we've decided to throw the rulebook out the window this month and introduce a few new segments into the show. I think it's fair to say that none of us really know how any of these might work, if they do work at all, that is. But this is where you guys listening might help us out. After this episode, we're going to ask you to vote for the parts you'd like to kill and the parts you'd like to keep for the next episode. I'll explain more about how you can do that at the end, but to start off, we're going to pick our company we never talk about. With over 90 stocks featured in the Invest app at the moment, it's inevitable that some, like Tesla, Facebook or Google, get talked about a lot more than others. So, before we came into the studio today, I asked Emmet and Rory to pick one stock that they feel doesn't get the attention it should and explain why it deserves its place in our 1% showroom. Emmet, what stock have you picked to give a bit of love and attention to today?
Yeah, well, actually, love is the appropriate word, because the stock I picked is Tiffany. Tiffany is an old world business, and buying diamonds for your loved one is as old almost as love itself. But what's very interesting about Tiffany is that it is, in essence, a retailer. They have points of sale, and in the last year they've actually reduced their store count from around 314 to about 310 stores.
Yeah.
However, they have grown the comparable store sales by about 7% in the last quarter, which is absolutely huge. If we look at some of the restaurant chains in our app, we know that 7% is really phenomenal growth.
Yeah.
Tiffany last quarter netted $1 billion, or in quarter one of this year, it had sales of $1 billion, which is up 11% from a year ago, which when you think about what they're doing which is selling diamonds, which has always been done, is extremely impressive with fewer stores. And what they really are exploiting now is their brand. And I think, as I ponder it, I think the world's awareness of ethical diamonds has increased, and when one goes to buy from Tiffany, not only are they getting an experience, not only are they getting that turquoise green blue box, but I think they're feeling, an average buyer will feel that the supply chain is cleaner and that there are no blood diamonds in that. So really, when I look at Tiffany as a stock we rarely speak about, I see one that is positioned to further grow their brand. They're getting more and more relevant. They're using icons of today to grow their brand. For example, Lady Gaga as part of their poster campaign down in Sydney. When I was down there last year, I saw that she was the figurehead.
Just one thing on Tiffany's for me is it's not just diamonds, right? They're kind of more modestly priced pieces of jewellery, I think, are iconic when it comes to occasions. I know my first Tiffany was a gift for graduation. It was from a family member actually based in the States. Wow. So there was even an air of kind of exclusivity from the box and from the unboxing. And I think I'll probably gift the next person in my life that I know who's graduating or who's young and going through a milestone a piece of Tiffany's jewellery. So that's cool. Embedded. You know, the brand is embedded as a gift for me.
Emmet, you mentioned brand there a few times when you're talking about Tiffany's, and it obviously has a very, very strong brand. You know, that teal blue box, it's very recognisable. But as we've seen with other kind of companies like Tiffany's, notably Michael Kors, brand is a very hard kind of moat to protect in some ways, because obviously as a retailer you want to sell as much of your product as you can, but the flip side of that is if everyone has a Tiffany's, the brand is kind of diminished maybe in some way.
Absolutely. The whole thing about a premium brand or luxury brand is exclusivity. And where Tiffany have positioned themselves is an exclusive product that's rare and also expensive. And if you look in the last year, as I mentioned, they have fewer stores now than they did 1 year ago, which is not the Michael Kors path. So Michael Kors, I suppose, in my opinion, lost strategic direction. The exclusivity was traded off to go into every other shopping mall in the US, and therefore that exclusive quality diminished. So I mean, you look at Tiffany again. Just sales in the Pacific region in the last year grew 23%, and Japan grew 12%. So we have new markets that they're growing their brand into and using that huge teal blue box or blue logo that is instantly recognizable, just as Ferrari red is a color that immediately evokes an emotion. The Tiffany teal evokes an emotional response.
Just like a note on Tiffany as well, like in order to protect their brand, I think like the vast majority of their sales come from items under $200.
Okay.
Yet you have to kind of go into the shop and ask for those products. They don't put them out front and center. They're hidden down the back.
All right.
So if you walk into a Tiffany store, what you see is the really expensive diamonds, the gold jewelry that costs a couple of thousand, and that kind of protects the brand. It keeps that kind of dilution of the brand down.
Okay, interesting.
They have a new CEO, by the way, and about $220 million cash on the balance sheet. So the business is in very good shape, and the CEO has a very clear focus on what he wants to achieve. And I think he has 6 priorities, which are number 1, evolve the brand message; 2, enhance the in-store presentation; have seamless omni-channel; get a more efficient operating model; and inspire within the organisation; and finally strengthen their competitive position, which is a nice rounded view of a business that is multinational and growing.
Yeah, cool. So then, Rory, which company have you picked that you feel needs a bit more attention?
Well, there's lots of them really, but one that really stuck out for me was Vail Resorts, ticker symbol MTN. It's a stock that I can't remember talking about in a long time, but it's actually doubled in value in the last 2 years. Over the last 5 years, the stock's up 333%. People who don't know it, Vail Resorts own a number of ski lodges around the United States and one in Australia. Not a high-flying tech company by any means, but when we talk about moats, things that protect your business, there's very few moats stronger than owning mountains. They're not making any more of them, or at least they're not making any more of them anytime soon. The last earnings report, their profits were up 42% year over year. They raised guidance as usual. This company just performs on every metric. Their season passes, which is where all their money is really generated, were up 12% in unit volume. They're up 19% in sales dollar volume. I think that really demonstrates that not only is there increased demand for these passes, but that people are willing to spend more year on year. So they've got a bit of pricing power there.
Obvious question maybe, but what happens when there's no snow?
It's a great question. It's a great question.
You go to the bar.
No, so yeah, that is an absolutely good question.
And that one more time, folks. That's a good question.
Are they affected by seasons and weather?
Yeah, of course they are, and we often kind of make fun of restaurant chains that blame poor results on bad weather, but this is a company that really does have that as a solid excuse. What we saw this season actually was the weather was poor at the start of the season.
Okay.
Picked up in the second part of it, and they kind of made up for the slowdown at the start, which shows people just want to go skiing. You know, if the weather's bad at one time of the year, they'll go at the next available opportunity. Your question to what they do in the summer is, well, they have a Australian mountain which they bought 2 years ago, I think now. So that's bringing in ski revenue during the Northern Hemisphere summer months. They've also launched a thing called Epic Discovery, which is kind of using the mountains for non-skiing purposes. Okay. So mountain biking, zip lining, nature trails, that kind of thing. It's not a major part of their business just yet, but it's a long-term vision that the company has for generating revenue year-round.
Yeah, so it's kind of venturing much further out into adventure sports as opposed to just skiing.
Yeah, exactly.
So that was the companies we never talk about section. The next section is one that I can safely say I've no idea what's about to happen because Emmet has refused to tell us.
Yeah.
Emmet, I might hand it over to you here and let you take it.
This section, folks, is called I Read a Book. And as its name suggests...
Tell us what book?
Recently?
Well, I'm glad you asked. I'm so proud of the fact I thought we'd make a podcast out of it. No, so I think what I'm positioning to us is that every month we try and pick a book we read and talk about it. Okay. So I read a book. Okay. Actually, specifically, I reread a book. So before I tell you about the book I reread, I have a little pop quiz. Okay. So most of us know the number one and occasionally the number two performer in every field. For example, who was the first man on the moon?
Neil Armstrong.
Very good. 5 points, Rory.
Thank you.
Who was the second man on the moon?
Buzz Aldrin.
8 points. Well done, James. Okay.
I don't get this pointing system.
So who, Maeve, was the 20th century's most successful stock investor?
That would be the Oracle of Omaha, Warren Buffett.
27 points, Maeve. Well done. So here we go. Who was the 20th century's second most successful stock investor?
Ooh.
Emmet Savage?
No. I wish I had those years and tenure and results, but alas, no. The second most successful investor was Shelby Davis. And we wrote a blog piece about Shelby Davis about a year ago, but I reread the book The Davis Dynasty by John Rothschild over the weekend. Okay. And I found it to be a great book. And what it brought was a lot of insights from a man who effectively turned an investment of $50,000 in 1947 to $900 million by the time he died in 1992. Wow. And that's one heck of a return. So as much as we all know who the great Warren Buffett is, the second great Shelby Davis is somebody we should just cast a light on now and again to understand what were the attributes that made him such a great investor. So basically, Shelby Davis invested almost exclusively in insurance stocks, which has a shadow from the great Warren Buffett, who also has a leaning towards insurance stocks, and specifically invested in US and Japanese insurance companies. He started off as a CBS radio reporter in New York, and also worked in the insurance business. So he developed an understanding of the insurance business. And just like Warren Buffett, he was very frugal. And as you read his book, you realise a little too frugal. And despite croaking it with 900 million in the bank, his family didn't enjoy many of the trappings of his great wealth.
Okay.
So you know, and I suppose that's a polite way of saying they really really were frugal. And there's a lot of nice quotes from the book, which I particularly enjoyed. One was, bear markets didn't rattle Shelby Davis any more than a fire sale at Bloomingdale's rattles the smart shopper. And I think I took a lot from that, whereas we in our lives are going to see a market downturn, and the human, the visceral, the fast reaction is to panic, when in fact the kind of enlightened investor will actually relish these moments to buy great businesses at discounted prices. And as lifetime investors, these are things we're going to have to do. So there were 9, I suppose, tenets to Davis's investment philosophy. And I've written them down because I read a book. And they are as follows, and let's walk through them. So he said avoid cheap stocks. And what that you might see manifested in our app is we don't look at penny stocks, which by definition, broadly speaking, is stocks that have a share price below $3 or $5, and that's a dangerous place to go fishing for investments, for reasons that we'll elaborate upon again. And his second was avoid expensive stocks. His third guideline was buy moderately priced stocks in companies that grow moderately fast, which is something we're trying to do in the market environment that we have at this moment. He believed in waiting until the price is right, so he sat on cash. He had a price target in mind for his businesses, which is easier to do in older world businesses such as insurance, to wait for a price target that you believe is fair representation of business. His fifth guideline was don't fight progress, and that's actually, there's a lot in that, and
that's an interesting one.
There's virtually a whole chapter on it. But we're living in very exciting times now in 2018. Progress is all around us. We can see it in every field. We've discussed how Amazon are now moving into the Premiership football territory, and this is an example of just a daily news story we're seeing of progress, and don't fight it, which leads into his next one, which is invest in a theme. So his theme was insurance stocks, and have thematic investments in your life. Buy what you believe in, understand what you own, or at least have a view that is supported by something you've learned.
Does that go against, in some ways, the idea of diversification, though?
No, it doesn't actually. So investing in a team doesn't necessarily mean that you're only going to stay in one sector or industry.
Okay.
I've always believed, James, that one's portfolio is effectively an autobiography of your beliefs.
Okay.
If I saw any kind of let's say advanced or intermediate investors' portfolio, it's as good as telling me what that person believes in. Like if you just look at someone's stock portfolio, 6+ stocks, that is telling you, if they're an active investor, what their vision of the future is, what type of person they are. It's incredible. The more you look at people's folios and the more you get to learn the person behind that folio, you start to see this is actually the perfect folio of that person if they're practicing it. So no, I don't believe it's anti-diversification. Okay. The seventh, let's say, rule or guideline that Davis went with was let your winners ride. And that's a really important point, because there is this compulsion, or at least this voice in one's mind, to sell your winners when they've banked some profits. And I looked at my folio recently, and I think almost half of it is made up of Netflix, which faces me with a decision, should I divest some of my Netflix shares? But I'm going to let my winners ride. When you sell, you're going to incur taxes, if you're not in a tax-protected structure. And you also have to basically deploy that cash in an investment that will grow to the value of the taxes you've just paid. He said bet on superior management. That's something we do here, and as we know, we spend a lot of time evaluating management with the tools at our disposal to make sure that only the stocks in our showroom have superior management. And his final guideline and piece of advice to investors like us was ignore the rear view mirror. And that's really important. I have to overcome this human bias every day. When I look at a great business, for example, Chegg, which just recently yesterday went into the Invest app, the rear view mirror shows me that stock has had a run. But in fact, we're looking forward at that business's opportunities. So the rear view mirror could cause you to do something that's just not really informed about the future. History just helps us evaluate what's coming.
Cool. And what's the name of that book again? Just so
It's called The Davis Dynasty,
The Davis
50 Years
Dynasty.
of Successful Investing by John Rothschild.
So that was Emmet's book he read this month. So the last section we're adding into this month's podcast is Maeve. I think I'll let you introduce this one.
Hello, listeners, and welcome to a new segment we're testing called Random as
I really hope we put the beep in there. So this is a new segment where Maeve kind of takes the lead and decides on a topic maybe that's in some way related to investing or the business world for us to talk about and chat about for a few minutes
but maybe
towards the end.
slightly more left of field.
Right.
So the topic this week is around any of the stocks that live in the Invest app, and it's going to be us tearing down some of their logos.
Logos, okay.
So in conjunction with the design team in Rubicoin, I had a quick check-in to see were there any logos that we all felt were less than good, and 3 companies in particular were repeated over and over again. Apologies to these logos.
And is this just in our app now?
This is just in our
wow,
app. Now
okay.
we can go outside the universe of our app, but I thought we'd start here because we all know them.
I think I know one.
It's going to be difficult for anyone listening, so hopefully you're aware of the stock and the logo, and if you're not, you're going to have to just take a leap of faith and listen to us describe it. So the top one that everyone on the design team here said that they weren't exactly enamoured with was Mazor Robotics.
Mazor
Robotics.
I wouldn't have guessed that one. That's
Yeah.
not as offensive as I thought.
It's not offensive. I think there's some mixed weight fonts in it, and also the
Spot the designer.
Mazor Robotics obviously is a very innovative. Is it a spine and brain surgery robotics company?
Spinal surgery, yeah.
Spinal surgery. So very impressive innovation, but for some reason they've gone with 2 kind of. I think they're supposed to be like nodding to incisions. So there's 2 kind of wisps to the left of the logo.
Okay.
That just didn't do anything for anyone.
Fair enough.
I'm sorry to the Oracle of Omaha. I mentioned them earlier, but it's Berkshire Hathaway. Was the yeah.
Warren.
I mean, the tracking and the typeface is incredibly dated.
Have you seen Have you seen his website?
I have seen their website, and it is inspiringly outdated. I don't know how they've
brilliant.
actually kept it on the web
Yeah.
for as long as they have.
Like someone
There's
took
no
a picture
about
of a,
us with like fancy down pictures.
No, it's like someone took a picture of a Word document.
Emmet, I don't think there's any pictures.
No, there aren't. I know.
And then this one I think is one that maybe everyone in this room will agree with, because I remember when we added it to Invest, there was a conversation. It's Sea-Trip.
Oh yeah, that was the one I guessed.
The dolphin.
Weird
The
looking
dolphin.
dolphin.
It's a kind of
The
a
dolphin.
sinister looking dolphin.
Yeah, it's like an evil looking dolphin.
Yeah, there's something
Yeah.
in his eye.
It's just China for you.
Have we any more to add to
Oh
those
yeah,
then?
Hain Celestial. And it's not coloured in properly. I don't know what the correct design term is, but
Okay.
the edges on it are not clean, and I've always had a problem with it. And we did, in our best of our capability, get the best version of their logo,
Right.
but the edges are a bit rough.
Okay.
So I don't know if anyone's listening from Hain, could you get on that, please?
What were the other 2, Maeve?
The other 2 were, now this was kind of more my voice, but people kind of nodded along. Planet Fitness, it has a strange kind of thumbs up.
Oh my god! Sorry, I just googled it. That is really awful.
I mean, look, I get it. It's fitness. It's a thumbs up. It's trying to kind of get you to feel motivated, but it's just, for me, it's slightly cringe.
That's awful. I can't.
Yeah.
It's been a while
But
since
thumbs
we
up are
added
all
that
in
stock.
at the moment. You look at the President of America, it's a thumbs up generation.
Does he do a thumbs up?
Oh yeah.
I know he does a baby finger.
No, but he
once.
does a thumbs up quite a lot.
Does he?
Actually, a lot of pictures,
Okay.
thumbs up.
I'll go and check that out. And then there was kind of some others floating around. I think the last one I'll mention is Activision Blizzard. There's just kind of there's a very mixed style between the top and the
Yeah,
bottom
they're
words.
very, very different. It's
Yeah.
it's kind of like this is front, party in the back.
Yeah, exactly.
Yeah.
And that can be
Yeah.
understood because of the nature of the company and the actual,
Yeah.
Can I
product.
mention one that's not in our showroom?
Yeah.
And it always comes up when people ask me the worst logo. Sherwin-Williams.
Sherwin
I don't know
Williams.
Sherwin-Williams.
They're the biggest paint company in the world. So their logo is like an outline of a globe with someone pouring a bucket of red paint over it, and it says "Paint the globe"
Oh God.
or "Paint the world." I can't remember, but it's absolutely awful. It's like
Sounds a bit grim.
yeah, pouring paint into the seas. Basically, it's really really bad.
Well, for straying off our app,
Yeah.
I think Checkpoint Software
Oh god, yeah, that's bad.
is.
I know
pretty
that
bad.
logo, and I'm
Yeah.
actually going to probably defend it. 'Cause
Really?
I think it's so bad that it's charming.
Really?
Yeah.
It
I
looks
do.
like a child drew it.
I know, there's something about it I find quite nice.
For a security company, doesn't really inspire confidence.
Okay. When it's paired with the actual offering of the company, we have a problem, but I do quite like the logo.
Cool, so that was our random as section. I don't exactly know what's going to come up next month if we keep it, but it was definitely interesting. So one segment we have kept from the previous episode is our elevator pitch, where Emmet and Rory give us a 30-second pitch on a company they're keeping a close eye on at the moment. Last month you guys picked a company outside of our showroom you're interested in. This month I asked you both to pitch a company that you think is coming back from the dead, so to speak. Emmet, we'll go to you first.
Okay.
And just a reminder at the end, myself and Maeve are going to pick which pitch we like best. So 30 seconds when you're ready.
All right, okay. I'll try and stick with 30 seconds when I finish this sentence, which is going to last the next 25 minutes. Okay, my turnaround is a stock that's not in our showroom, and it is very risky, and that's why it's not in our showroom. And it's that old chestnut from the world of mobile, BlackBerry, which was once synonymous with presidential telephones, mobile phones, and enterprise level security. So BlackBerry is a Canadian company. They put in a turnaround specialist CEO recently called John Chen, and the business has completely pivoted into the world of software for cars, and they have a technology called QNX technology, which all the major car brands are deploying. 40 of the automotive original equipment manufacturers, OEMs, are using QNX technology, and it looks like a business that is successfully implementing a whole new strategy with software that is now in 140 million vehicles and growing, and I think it looks like one that is getting ready for a whole new wave of growth.
Okay, cool. Didn't expect BlackBerry, I have to say. Rory, your turnaround company.
Yeah, so I wouldn't call it a turnaround just yet, but the stock of this company is up 65% year to date. And that stock is TripAdvisor.
Okay.
After a few missteps over the recent years, they've delivered 2 really solid quarters, and it's really demonstrating that the company still have a strong network of engaged users. That stands currently at about 450 million monthly visitors, and they're drawn to TripAdvisor because there's over 600 million high-quality reviews on the site. They're seeing good growth in their non-hotel segment, which saw an increase of 36% year over year. And while competitors like Trivago are really struggling, TripAdvisor's meta search platform is the prices on that are stabilising, which I think shows the quality of the service they offer.
Cool. Maeve, TripAdvisor or BlackBerry?
I rely heavily on TripAdvisor for research purposes before I go away, so I'm going to buy in with Rory this time and go for Trip.
I despise TripAdvisor.
Okay.
Just the platform. I don't like using it. I think it's awkward, so I'm going to go with BlackBerry just to give it a blast from the past. So
I couldn't really by principle go with BlackBerry because I got burned last time with Emmet's for the hardwood floors. Right. What were they called?
Lumber liquidators.
He threw you a curveball.
I
in the last
voted
episode.
for Rory, I believe. After.
So that brings us to the end of today's episode. As I've mentioned already, we want your help in deciding which parts to kill and which parts to keep for the next episode. If you go to the Rubicoin Twitter page now, you can vote on each of our 3 new sections to let us know if you'd like to hear it again next month. If you miss out on the Twitter poll, however, you can still let us know what you think across the month. Get in touch with us on Twitter or Facebook, leave a comment on the podcast episode itself, message us through the Learn or the Invest app, or email us at pod@rubicoin.com. That's pod@rubicoin.com to let us know what you think. If you've any other suggestions as well, completely brand new sections we could include, we'd love to know, so get in touch with us for those either. That's about it for us for this month. As always, there's plenty of new things to check out in the Invest app too, including a new star stock, Chegg, which Emmet already mentioned, that we added on Monday of this week. Thanks for listening in. Please make sure to rate, review and share the podcast if you enjoyed today's episode. From myself, from Emmet, from Rory, from Maeve, happy investing, and we'll see you next month.